Your credit score is literally judging you right now. And that invisible number between 300 and 850? It decides whether you get approved for that apartment, that car loan, or whether you're stuck paying double-digit interest rates for the rest of your 20s. Wild, right? A number you probably don't even know is controlling your entire financial future. So, what is your credit score really telling the world about you? And more importantly, how is it quietly sabotaging your wallet while you're just trying to survive? You're watching M-Cubed, Money Mindset Makeover. This isn't just a channel, it's a mindset revolution. Subscribe to elevate your money mindset, elevate your life. And stick around, because today, we're cracking the blueprint that can take you from broke to baller. By the end of this video, you're gonna understand exactly what your credit score means, why it matters more than you think in 2026, and the 5 moves you can make right now, whether you're 18, 22, or 29, to stop letting this 3-digit number wreck your financial future. Let's dive in. All right, real talk. Imagine you've got this friend. Let's call them Sam. You've known Sam for 10 years. Sam calls you up one day like, "Yo, I need $500 for car repairs. I'll pay you back next month with a little interest." You'd probably know instantly whether Sam's good for it or not, right? Like based on your history with them, you'd know if you're getting your money back or if you just funded Sam's weekend in Vegas. Now flip the script. What if a complete stranger, someone you've literally never met, came up to you at Target and asked you for $500? You'd be like, who are you? That's the position banks are in every single day when you apply for a credit card, a car loan, or a mortgage. They don't know you. They don't know if you're responsible or reckless. They don't know if you're gonna ghost them with their money. Enter your credit score. Your credit score is basically your financial reputation score. It's a number between 300 and 850 that tells lenders how likely you are to pay back money you borrow. Think of it like your financial GPA, except this one actually matters after graduation. Before credit scores existed, getting a loan was a whole relationship thing. You had to know the banker personally. It was all handshakes and reputations and my dad knows your dad energy. If you were new in town or didn't have connections, good luck getting approved for anything. But now, your credit score does all the talking for you. It's maintained by 3 big companies, Equifax, TransUnion, and Experian. And they track every payment you make, every account you open, every time you're late on a bill. They keep a record of your financial behavior for the past 5 to 7 years and turn it into one simple number. High score? Banks roll out the red carpet. Low score? You're getting rejected faster than a left swipe on a dating app. Now here's where it gets slightly annoying. There isn't just one credit score. The 2 big ones you'll hear about are FICO and VantageScore. Think of it like this. Imagine you gave 2 chefs the exact same ingredients and told them both to make chicken parm. They're working with the same stuff, but the final dishes are going to taste a little different because each chef has their own technique, their own style, their own secret sauce. FICO and VantageScore both pull from the same data in your credit report, but they weigh things differently. One might care more about your payment history, the other might focus harder on how much debt you're carrying. Plus, both have been updated over the years, like software updates on your phone, so you might run into older versions still being used, especially when you're applying for something big like a mortgage. But here's the deal. You don't need to stress about which one is which. What matters is understanding how all of them work, so you can play the game smart. The highest score you can get is 850. The lowest is 300. If you have 0 active accounts on your credit report, your score will actually be 0, which isn't necessarily bad. It just means you're not participating in the debt game at all. Some people think that's a flex. Personally, I think it's smarter to keep at least one account open, like a credit card you pay off in full every month, because it makes life way easier when you actually need to borrow money for something big. What's a good score in 2026? Everyone's got a different answer for what's a good score in 2026. But let me keep it simple for you. 650 plus, you're doing a good job. Not perfect, but solid. 750 plus, you're doing a great job. Banks love you. Under 650 time to level up, friend. And look, if your score is sitting somewhere around 580 right now and you're feeling some type of way, don't spiral. You're not broken, you're just early in the journey. Stick with me, because we're about to break down exactly how to fix this. Let's zoom in on why this even matters to you specifically. Because here's the harsh truth. Your credit score isn't just some random number floating in cyberspace. It's actively controlling your life in 2026. Want to rent an apartment? Landlords are checking your credit. Want to finance a car because yours just died and you need to get to work? Dealerships are checking your credit. Want to get approved for a phone plan, a personal loan, or even some jobs in finance? They're all checking your credit. And if your score is low, you're getting hit with higher interest rates, bigger deposits, straight-up rejections, or worse, you're stuck paying predatory payday loans just to keep your head above water. This is the game millennials and Gen Z are playing right now. You're already drowning in student loan debt. Rent is eating half your paycheck. Wages haven't kept up with inflation. You're working 2 jobs and a side hustle just to survive. And on top of all that, the financial system is also judging you based on a score you probably didn't even know existed until you got denied for something. You're not lazy. You're exhausted. And the system profits off your burnout. Sound familiar? M-cubed family? I say it here in most of my videos because we speak the truth. But here's the real twist. Once you understand how credit scores work, you can actually use the system to your advantage. You can flip the script. You can go from getting rejected to getting approved, with better terms, lower rates, and more financial freedom. Have you or someone you know ever been denied because of bad credit? Drop your story in the comments. Your experience might help someone else avoid the same trap. All right, let's break down the 5 factors that determine your credit score. Think of these as the 5 boss levels you need to beat to win the game. Factor 1. Payment history, 35% of your score. This is the big one. A full third of your credit score comes down to one simple question. Do you pay your bills on time? Student loans, credit cards, car payments, rent, if it's being reported. All of it. If you pay on time every single month, your payment history is flawless and your score is climbing. But if you're late even once, your score takes a hit. Late twice? You're in the danger zone. And those late payments? They stick around on your credit report for up to 7 years. That means one dumb mistake when you're 22 could still be haunting you when you're trying to buy a house at 29. So yeah, automate those payments, set reminders, do whatever you gotta do. Because this factor alone can make or break you. Factor 2. Amounts owed, 30% of your score. This one's all about how much debt you're carrying compared to how much you could borrow. For long-term loans like student loans or car loans, lenders want to see progress. If you've been chipping away at that loan for years and it's 80% paid off, that's solid. But if you just financed a brand new luxury car with 0 down and haven't made a single payment yet, red flag city. Also, please don't finance a BMW 5 Series when you're 23. Your future self will thank me. For credit cards, this is about your utilization rate, aka how much of your credit limit you're actually using each month. The golden rule? Keep it under 30%. Better yet, under 10%. So if you've got a credit card with a $1,000 limit, you want to keep your balance below $100, $300 max. If your statement balance is $850, your score is tanking. Here's the hack. Pay off your card weekly or bi-weekly instead of waiting for the statement date. That way, your reported balance stays low even if you're using the card regularly. Factor 3. Length of credit history. 15% of your score. This one's simple but sneaky. The longer you've had credit accounts open, the better. If you got a student loan 12 years ago, that account is 12 years old, even if you didn't start making payments until after graduation. If you opened a credit card 6 years ago and kept it active, that's 6 years of history. Your score looks at the average age of all your active accounts. And here's the kicker. Once you pay off an installment loan, like a student loan or car loan, in full, it stops counting toward your credit history. So, if that was your oldest account, your score might actually drop when you pay it off. Wild, right? It's almost like the system was designed to keep you in debt forever. Go figure. Factor 4. Credit mix. 10% of your score. Lenders like variety. They want to see that you can handle different types of debt at the same time. So having a mix of installment loans, like a car loan or student loan, and revolving credit, like credit cards, shows you're responsible and can juggle multiple accounts. It's a small factor, but it adds up. This should also be monitored as to not get new cards from every retail store or hardware store where you shop. Factor 5. New credit. 10% of your score. Every time you apply for a new credit card or loan, the lender does what's called a hard inquiry on your credit report. And those inquiries ding your score. One inquiry every year or two? No big deal. But if you're applying for 5 credit cards in 3 months, banks start getting nervous. They think you're desperate or about to max everything out and disappear. Hard inquiries stick around on your report for 2 years, so be strategic about when and how often you apply for new credit. Alright, now here's the mindset shift. This is where broke ends and ownership begins. You don't need to be a finance bro to win at credit scores. You just need to be intentional. Here are 5 smart, basic moves you can make at 18, 20, or 25 to set yourself up for life. 1. Get a credit card and use it responsibly. Even if it's a secured card with a $300 limit. Use it for gas or groceries, then pay it off in full every month. Never carry a balance. This builds payment history and keeps your utilization low. 2. Automate your payments. Seriously. Set up auto pay for the minimum payment at the very least. Late payments are the fastest way to wreck your score, and they're 100% avoidable. 3. Keep your oldest accounts open, even if you don't use them. Length of history matters, so don't close that first credit card just because you got a fancier one. 4. Become an authorized user on someone else's card. Ask a parent or trusted friend with good credit to add you as an authorized user on their account. You don't need the physical card, you just need your name on it. This can boost your credit mix, your history length, and lower your utilization. It's a triple win. 5. Check your credit report for free once a year. You're entitled to a free report from each of the 3 bureaus annually. Look for errors, fraudulent accounts, or anything sketchy. Dispute mistakes ASAP because they can tank your score for no reason. Look, your credit score isn't everything, but in 2026, it's definitely something. It's the difference between getting approved and getting denied. Between paying 6% interest and paying 24%. Between financial freedom and financial frustration. The good news? You're not stuck. You can build this. And where needed, you can fix this. And now you know exactly how. Be sure to stick around for the next video. Roth IRA explained why you need one in your 20s. This will piggyback what you just watched perfectly and be a blessing in your life. I know it, M cubed fam. See you there, M cubed family.